Let's talk about a company called Eagle Materials. Now, on the surface, it's in what you might call a boring industry. I mean, we're talking basic building materials. But as any good investor knows, sometimes the most brilliant, high-performing businesses are the ones hiding in plain sight. So we're going to dig in and see what makes this company so special. And it's a totally fair question, right? Cement, concrete, drywall, these things are literally the building blocks of our entire economy, but they don't exactly scream high growth or high tech. So how on earth does a company like this become an absolute powerhouse of profitability? Well, the answer really starts with this one jaw-dropping number, 32.4%. That is Eagle's return on equity. Now, in simple terms, that means for every single dollar of shareholder money that's in the business, Eagle generates over 32 cents in profit. Think about that. That is an incredibly efficient operation, and it blows past companies in much, much sexier industries. So the real question for us as investors is, how do they do it? They do it by building a really, really powerful competitive moat. And honestly, the best way to think about Eagle's strategy is with this analogy. They aren't trying to be some giant global whale. They are perfectly happy being the dominant regional shark. Let's break down exactly what that means. Okay, so at the absolute heart of it all is one simple, incredibly powerful idea: be the low-cost producer. See, in a commodity business where your cement isn't really all that different from the next guy's, the company that can make it and deliver it for the lowest possible cost wins, period. For Eagle, this isn't just a goal, it's woven into their operational DNA. And this slide just illustrates that shark versus whale dynamic perfectly. You've got these massive competitors, the global whales like Vulcan Materials and Martin Marietta, that operate on a huge national scale. But Eagle, the regional shark, focuses intensely on very specific areas: the U.S. heartland and the Sun Belt. Their plants are strategically located away from coastal ports. Now that's a genius move, right? It insulates them from cheap imports and lets them just dominate their local markets. They'd rather be wildly profitable in their own ponds than just be the biggest fish in the entire ocean. And this whole focused strategy, well, it's reflected right in the company's structure. You can think of the business as being powered by a simple but really effective two-segment engine. So, as you can see, revenue is split between heavy materials, which makes up about 59%, and light materials, which accounts for the other 41%. It's a really nicely balanced mix with just a little more weight on that heavy side. So you've got the heavy side, that's your cement and concrete, which mostly feeds into big infrastructure and commercial projects, things often funded by government spending. Then you've got the light side, that's your gypsum drywall, which is tied directly to the housing market. Now, here's the brilliant part of this whole structure. It acts as an imperfect hedge. Basically, these two segments are driven by completely different economic cycles. So if there's a big slowdown in housing, it can be buffered by a surge in infrastructure spending. It just creates a more stable, more resilient business through all the economic ups and downs. Okay, so we've established we have a highly efficient, really well-structured business. But for any investor, the key question is always about what's next. So how does this well-oiled machine actually plan to grow? Well, the answer lies in a super clear and focused dual-pronged strategy. You're not going to find any wild Hail Mary bets here. This is all about disciplined, methodical execution. Part one is what they call organic modernization. They are just pouring money back into their own plants to make them even more efficient, to expand their capacity, and to solidify that low-cost advantage even further. Part two is disciplined M&A. Now, they're not out there hunting for massive company-changing deals. Nope. Instead, they're buying smaller, bolt-on businesses that fit perfectly into their existing geographic footprint, which makes their regional dominance even stronger. And, management has been absolutely crystal clear about where their focus is. They have stated, very plainly, that they want to grow the heavy side of the business. From an investor's perspective, this is just a really, really smart move because the cement and aggregates business has incredibly high barriers to entry, which gives it a much more durable long-term competitive advantage. All right, so this all leads us to the big money question for any potential investor. What is this company actually worth, and what are the risks? Is there a real opportunity here? Let's just look at the raw numbers. This table compares the valuation of Eagle to its giant competitors using a metric called EV to EBITDA. Now, don't get hung up on the jargon. Just think of it as the price tag for the entire company relative to its core earnings.
And just look at this. Eagle trades at a multiple of about 10.7 times, while its peers are way up there, around 19 times. That is a massive difference.
And if the table wasn't clear enough, this bar chart makes that valuation gap just impossible to miss. Eagle Materials is trading at a discount of over 40% to its larger rivals. So the crucial question you have to ask is, why?
This quote really sums up the whole bull case perfectly. The thinking is that the market is overly penalizing Eagle's stock because of its exposure to the very cyclical housing market through that wallboard business. But in doing so, it might be completely undervaluing the company's incredible, best-in-class profitability and its rock-solid heavy materials division.
Of course, no investment is ever a sure thing. A smart analysis means you have to look at the other side of the coin. What could actually derail this whole story? Well, there are 4 big ones to keep an eye on. First, you just can't forget this is a cyclical business. If the U.S. economy and the construction industry as a whole hit a major downturn, Eagle is absolutely going to feel it. Second, its light materials business is very sensitive to what's happening in the housing market and with high interest rates. Third, a big spike in energy cost could seriously squeeze their profits. And finally, the cement industry as a whole faces some pretty significant long-term regulatory pressure to decarbonize, and that's going to require a lot of investment. And all of that leaves us with this final, absolutely critical question. We know Eagle Materials is a superbly run company. I mean, they are a true master of operational excellence. But is that excellence a deep enough competitive moat to protect the business if a major economic storm hits? That right there is the core question an investor really has to answer.